it's Brad with Ocean Consulting Services, and today's video will discuss releasing of IRS tax levies. Let's start off with a fairly common scenario. You owe the government money and you have a plan. Your house has equity, so you decide to sell the house. You have a first mortgage, but you have equity available to pay the IRS and maybe put a few dollars in your pocket. So you go and list the house, you line up a potential buyer, and lo and behold, the buyer backs down. When you ask why, they say because the IRS has a lien on your house. So what happened? Well, the IRS has what's called a silent lien. It applies anytime you have a tax debt to the IRS once it's been assessed. So basically 10 days after they bill you, and if it's not paid, it's determined to be assessed, and at that point there's a silent lien, and they call it silent because it automatically applies to all your property. Typically with real estate, they'll actually do a filing. It's called a notice of federal tax lien, and that notifies everyone, including your potential buyer, that the IRS has an interest in the home. The IRS doesn't want to own your home. They don't want to own your assets. They really want to be paid. So the purpose of the lien is not to seize your property. It's really to let the world know that, if that property were to be sold, the IRS has a right to that. So in your situation, the IRS actually will allow for sale of the property because there's enough equity. They'll be paid. There'll be some money left over. So again, they'll allow it, you just have to go through some steps. It's called, the IRS releases the lien on that property. They don't give up their entire lien, but in your case, when there is equity in the property, what will happen is the first lender will be paid. Once a sale happens, first lender will be paid. IRS will provide a payoff letter to for the closing. And it's similar to home equity line of credit. They'll be paid second in full, and anything left over will go to you. And at that point, they'll release the lien on the home so that the buyer will obtain a property without a lien. So what's another common scenario with a house? Well, one is when you can sell the house, there's equity, but not enough money to pay the IRS. So what happens? So in this circumstance, you need to prove to the IRS, here's a reasonable selling price, here's what I owe on my first mortgage, and whatever's left over, you'll have a preference to. So what happens? You sell the house, first loan gets paid in full, and any balance goes to the IRS. IRS still has a lien against your other assets, but they've allowed the sale to go through. So now what happens in a short sale situation? So a short sale, obviously, the first lender isn't going to be paid. Would the IRS allow that? Yes, they would, because they're not being hurt by releasing the lien, and potentially they're being helped because they're getting you out from the mortgage, and maybe there's more proceeds available for a sale. So again, they'll release the lien, let the property be sold, and but they will remain obviously a lien outstanding against your other assets. So now let's take another situation. What about a refinancing? They'll usually allow for a refinancing. Technically the IRS can't prevent you from refinancing. There's no mechanism that says you can't refinance. The problem is no lender would refinance your loan, because what they'd be doing is putting the IRS ahead of their lien. So in other words, say your current mortgage holder has the first lien, IRS steps behind them in the second lien position. Well, if that first loan goes away and a new loan gets created, the IRS has priority now. So what happens in that circumstance? Well, if you can prove to the IRS that it's to their advantage to let you refinance, for example, if you free up some more money for your monthly payment, or if you can access some equity and make a payment towards your tax debt, they'll allow it. They'll subordinate it's called subordination. They'll put their lien ahead of the lien for the new loan. So they will allow for it. A couple other topics with smaller debts, those $25,000 and less, the IRS will allow the lien to be taken off of the property. You have to satisfy a couple requirements. One is you enter into a direct debit arrangement with them. In other words, you allow for automatic payments from your checking account. and you have to make 3 successful payments, but after that you can ask the IRS to remove the lien, even though the tax debt remains outstanding. Another note is that liens are self-releasing. In other words, once the IRS can no longer pursue you, which is typically 10 years from the time the tax is assessed, the IRS has no right to go after your property. So the notice of lien usually will list a date on there that tells the world that after that date, they don't have to worry about the lien. There's no formal process. The IRS does not withdraw a lien. So sometimes you'll see taxpayers saying they have liens on their property, but when you look at the lien itself, it's expired. And the IRS does not have to do anything affirmatively it's self-releasing, so it releases on its own. So now what's a summary of this? Again, the tax lien is a powerful tool. It's used by the IRS in their collection activities. But again, as I mentioned before, they don't want to own your property. They're not in the business of owning, maintaining, selling property. They want to be paid cash. So the lien really just serves as a holder to tell the world that, if that property is sold, the IRS has an interest in that. And if there are situations where the IRS is helped by, for example, subordinating the lien or allowing the lien to be taken off a certain property, they will work with you as long as it's to their benefit and you can prove that. So hopefully that helped out in your understanding of how to release a lien. Stay tuned to this channel for some more information regarding other tax topics. Thanks, bye.